All right. Good morning, everybody. We're back. Sorry about yesterday. The living in Kansas on top of a hill. If the wind gets bad, and the wind is always bad in Kansas, it flickers my power. My backup got depleted, and I just couldn't run a continuous run without getting booted. So couldn't do the live stream. That's the first one I've missed, I think, since the trip to Denver a couple of years back. Been a while, that's for sure. It happens. So we continue with the Mag 7 earnings. The uh the the headlines that came out of FOMC was this December rate cut not being a guaranteed thing, removal of forward guidance. But if you were watching, the the drop came before that comment on other comments that he had made. So while the headlines are focusing on the easy things, I don't think it was the December lack of forward guidance. I'm sure that that didn't help either, right? It's not like we can just dismiss that and say it had nothing to do with it. Just that there was more to it than that one statement. Meta has impressively spent massive amounts of money, just mind boggling amounts of money to hire this super team. And in their earnings yesterday, they said next year they plan to spend even more than they did this year. And I think out of all of the earnings so far, Meta has exemplified the concept that it's just going to cost more and more and more, especially as demand continues to rise, and that it's a vicious cycle propped up by the major players in some crazy little pyramid scheme. They have to keep fueling everything higher and higher and higher and higher and higher. But I mean, the main takeaway is there's still a boatload of spending. And as long as that spending coming in, then all of the ancillary things that are benefiting from that spending are going to continue to benefit. The CTAs are still not back to their previous position size, even with this hockey stick to the upside. So we want to continue to keep our eye on CTA positioning. This is not a trigger to go long or to go short or anything like that. It's just a gauge on their participation, right? Are they lightening up? Are they doubling down? Are we nearing a previous level of allocation? And at the moment, we are nowhere near that previous level of allocation. So we have no expectation that they're going to reduce positioning. Now that S&P and NASDAQ chart, they look really similar in that regard. If you take a look at gold, they are still exiting out of that, reducing their position size. Take that with a grain of salt. We can see many times in the past where they were liquidating their position size or reducing their risk, and gold just continued to go up. So just because they are lightening their load does not mean that gold is destined to go down with it. Same thing with silver. You know, their position sizing actually had reached new heights, and now they're liquidating. It's very likely they're going to continue to liquidate back down into this 01 level. If not, then triple aught down here. But we've seen them liquidate even as silver continued to rise. So just because they're getting out does not mean it's got to go down. And the poor man's gold, copper, holding within this range of allocation. And copper still got a ways to go price-wise until it gets back to the highs. It's already through the midpoint, the risk zone. So we made it through one level of significant risk. We have another one here at OCT3. And then we can get back to previous levels. I like copper. Copper is my China play. Has been for a couple of years. All right, so Japan is doing good, up more than 0.75%. The UK down more than 0.5%, and then everything else spread out in the middle. The Dow, not a quarter to the downside. NASDAQ, S&P, basically flat. Small caps up 0.25%. You want to be watching those small caps today, see if we get that rotation that we've been getting. Right, the typical rotation is small caps do good in the pre-market. Then we get into the regular session and they kind of take a back seat to bigger and better. So keep our eye on that, see if we get that rotation or not. If we don't get it, it's a little bit of a continuation hell, right? That we're going to stay stagnant, not get that breakout, not push higher. That's the way I'm reading it at the moment. So just kind of keep your eye on them, even if you don't want to trade them. If they don't fade out, if they continue to dominate, then you know, this sideways weakness could stick. We're supposed to be getting job numbers, but as you can see with the government shutdown, we're not going to get these initial jobless claims and GDP numbers. I really feel, and I've continued to say, that getting a credit downgrade is going to be a really big deal if and when we get it. And I've gone back and looked at some of the threats that have been made about issuing a downgrade, and a lot of those threats revolve around Congress's inability to get things done. When there was threats of government shutdown, there were threats of getting a credit downgrade. Well, I mean, we're in the shutdown. So, you know, it's time to pony up. Otherwise, all of those credit agencies that were threatening to downgrade, you know, they lose their trust value. We're going to get the FOMC version in Europe with Christine Lagarde and their rate decision through the morning. We've got Scott Bissett out there chipping his teeth bright and early. And really, I think we're just going to be sitting in a holding pattern, waiting for the Mag 7's earnings tonight to continue, right? This is Mag 7 week. We're going to be getting it all week long, which is another reason for the expectation that this week was expected to be a sideways week. Everybody has to see how the Mag 7's earnings go to figure out where the broader market is going to go next. So why allocate into a bunch of stuff if you're just going to have to rotate right back out of that? If you're going to go from growth to value or value to growth, vice versa, you need to see how the Mag 7 is going to perform. Once we get that out of the way, it would sound like smooth sailing, but then we're going to be into a new month, and we're going to have QRA next week, Monday and Wednesday. Monday at 3, Wednesday at 8:30. I'm really proud of Google. I don't know why it's not my baby, but I'm still really proud of Google. So we faded back to the 3-period daily moving average, bounced on that, and now we're hitting that 69.32 cog line. It's almost the midpoint of the Europe Open bar, that kill zone move. If we was to measure this, it did cause a little bit of a liquidity gap. So the expectation is that we get back up into that 47 level to at least get the gap closed. It's not like I think we're going to get bullish after that. Just I expect that gap to close. It's not to say that we couldn't get bullish, just the expectation for any move up is that we at least get there, and then we'll see. We got that big round number 69.50 to deal with. You can see it's a significant level. We've been fighting it multiple times. And if you look at it on the daily, 3 different days we've tried to hit through this level, and we haven't been able to do it yet. So if you're looking for like maybe a visual or an analogy, is that there's a lot of structure up here, kind of like a Pac-Man type behavior. We got to chew through all of this. Every time we get up into that level, we're absorbing or chewing through or taking more away from this ceiling that is blocking us. And if we can chip enough of that ceiling away, then we can get through it and continue to go up. The question is, will we continue to have the strong enough demand to A, get us into those levels, B, absorb all of those levels, and then C, after all of that, still have enough demand to continue to go higher? Or will they get frustrated, throw their hands up, and back away? We don't know yet. The fact that we continue to get higher highs on each attempt is a positive outcome. If we were running OCR type analysis, the higher highs are certainly helpful, but the lower close and the lower low, this outside bar, it's not a good tell. One of the caveats to that is that it was an economic event bar, and so these outside levels can be taken with a bit of a grain of salt because of that. Otherwise, we have a matching low to this previous low, discounting the event bar in the middle, and we still have the higher high. If we was to close at the moment, we would also have that higher close. So I like what we have so far. We just need to resolve it. We are IX10. Some analysts wouldn't call it that because we escaped the range with these wicks, but we didn't close outside the range. And that's more of what I'm focused on, not the wicks. So this is the range, and this is why we're IX10. Yesterday was an inside day. If you have another inside day after the first inside day, that's when we start calling it IX10. I didn't name it that. This concept has been around long before I was trading. It's just multiple inside days. It's also considered NR2 at this point, narrow range 2. Once this bar closes, we will be in narrow range 3 as long as we continue to stay inside of this. We can't stay here forever. Sitting here without breaking down is healthy. It's a digestion and a correction. Markets need to correct. If they move really far, really fast, they need to correct. Now they can correct 2 ways. We can turn around and go back the way we came. That's one way to do it. Or we can sit here and consolidate and heal from the rip in price that we took, right? Just like ripping a shirt or cutting yourself is considered a rip in the skin. It's got to heal. So heal from this rip, get a correction, and then resume the move, or we end up retracing and trying to fill some of these gaps that we left behind. Overnight volume around 90,000. It's a little more than the average that we've been getting, but it's not extreme, and it just highlights that participation. What that level of volume tells me is that there wasn't anything last night that had them scared or worried and sitting out waiting. If the volume had been really light, we would have to consider, what were they waiting for? Why were they sitting out? And if it was really heavy, we'd have to ask, what the heck happened last night that caused them to pile in with such abandon in those hours? So it's not too heavy. It's not too light. We're good. It's not really much of an issue, but it's worth checking every morning to kind of give you a feel on, hey, what the heck happened last night? Because I don't know about you guys, but when I get up in the morning, there's a lot of news to absorb. And that volume kind of gives me a tell on where I should be looking for news. In the drama section or maybe in the macro section. Usually if it's drama, it's on everything. Headlines like hurricanes, bombs, something getting stuck in a canal, those sort of issues. We can hit the upper ADR easier because it's inside the same range that we're in. To hit the lower ADR, we would need an inside day breakout. That's the only reason that it's more likely we'll hit the upper one rather than the lower one. We're basically flat on the day, so we don't have any real edge to get to one side or the other. But since we're in the same box, it's just easier to hit that line because we're closer to it. Some could argue that the line was there all night, even though on this platform, it only shows it starting here at 1 a.m. So if you was to visualize the idea that it was here all night long, then we've already hit it. And if we hit it and we failed to get through it, now we're working our way down. If we break this Globex low, we're going to challenge the low of yesterday, and then we're going to get down into this lower ADR. And I like that idea. That's the base case argument at the moment. If we can get through our own Globex mid, just take it from the low here. Actually, that's not the low we want. We want that other one. Take it from the low here because it's the lowest point of the Globex and run it up to the highest. That's the mid that we need to get above and keep. That's a really nice reversal bar right there. That's a textbook picture. For those of you who know that we've talked about this so many times, reversal patterns. I mean, this bar, if it looked like that bar, would have been better. That would have been the best. But that's really nice. So we got to get above this level and keep it, or we got to get below this level. If we can stay above this one, we'll get the ADR, get above that, get our inside day breakout, and go for the full ADR. Otherwise, break this low, get to that, break that, get to this, break this, get to that. Easy, easy, right? It really is that easy. We were having a talk yesterday about FOMC weeks and how it's difficult to trade when it's just this sort of choppy, sloppy mess. And the idea is that, sure, we can trade whenever we want, right? As long as the market's open, we can trade. Absolutely. But you got to ask, do I really want to, right? Because if it's elevated risk and it's just a bunch of chop and slop with big, wide, violent bars that require you to use a larger stop, then you have lower conviction and higher risk. Why would you bother? Right? That's a Netflix and chill day, or maybe run a little Minecraft, or just, I don't know, read a book. do something else. We don't see any hedging signals. There's no market maker move. We have a very narrow CPR. I don't normally call it a CPR. It just confuses people. The central pivot, the pivot point, also called a floor pivot, is that purple line. That's your daily floor pivot. The yellow channel around it is what they call the CPR, central pivot range. Okay? And it's all a math formula. If you was to go to Google and type in central pivot range or CPR, you would get the math formula, and you can run that on any time frame you want: hourly, 15-minute, daily, weekly, monthly. There's no end to the creativity there. Where the floor pivot is in relation to the previous day's pivot matters. Today's floor pivot is lower than yesterday. That's bearish. Price opened above it. That's bullish. They kind of cancel each other out. And then how wide or how narrow the range is a little bit of a tell. The wider the range, the more likely it is that we're just going to stay stagnant and stalled, and that we very likely won't break out of the previous day's range. It also implies if we do break out of the range, it doesn't stick, and we just end up right back inside the range again. But a narrow central pivot range implies that a breakout is possible, and that if we do get a breakout, the breakout sticks and we continue to run in the direction of the breakout. This channel and these floor pivots do not make price do anything. So just because the central pivot range is narrow does not mean we have to break out. It won't make us break out. And if we do get that breakout, it doesn't mean we can't come back in again. Price can do whatever the hell it wants. And it doesn't make price keep the breakout and run. It's just a tell on what to expect if we did get a breakout. Statistically speaking, if you have a narrow channel and you get the breakout sticks and we continue to run. That's the way it goes. Sitting right here on this time frame with this floor pivot easily in view, this is a really great way to see the destination, especially by Friday. So this lower level down here, 67.85, that is the weekly floor pivot, and the yellow lines around it are the weekly central pivot range. If we break down below yesterday's low, that's the target. I would expect that we could do it all in one day. I really do, because that's an easy jump. That's really not much of anything. But getting there by Friday is a better way to say it. We still have to break down, though. We still have to GTFO this box. And before we make that run, it's very likely that we run up and break the top of the box first. That would help with this distance, because if we get too far away from that weekly pivot, we have a little bit of a mean reversion behavior. Well, the distance that we got there Tuesday was barely exceeded. On Wednesday, we got just a little bit higher, and again, just a little bit higher. Why not, right? One more time, get up into that 69.60 area, get just a little bit higher, and then wash that thing back down to the weekly pivot. If we begin this journey to the downside, there is the round number 6,900. Then there's the low of yesterday. There's also a 68.92 cog line in here. Then we've got the low of this gap up. Then the high of Friday. And the close of Friday. And then the floor pivot. So as you can see, we've got level by level by level all the way back down. And I wasn't very exact with those lines, right? I wasn't getting them snapped necessarily to the right spot. But you'll be able to figure that out, right? And then, of course, you got the 0 gamma, the volatility trigger, the put wall, the lower moving averages. All of those things are down there. And you could apply Keltner channels, Bollinger Bands from the daily and the weekly and see if there's any of those things down there that we could hit too. 68.45 is the 10-period daily moving average, which is in the middle of this gap. So that would be another line, another useful line, plus the 68.50 level. That big options level is almost right in the middle. So that's going to add just another line. And they're just targets, right? If you get through one, you got the other one. You get through that one, you got the next one. Running it with the fib walk, where we continue to expand the fib after every new OCC, and you can run it all the way down. I know because we've done it before. We have hit our one that offers S2, 68.50. I like it even more. Just continues to add up. 68.50 is looking really good. Now, having said that, you know, this market, we've looked down and down and down and down, and we've just continued to run higher. So while everything I've got this morning is saying we're going to stay sideways or break to the downside, if we break out and get through the 111 and the 1236 to the upside, I'm not going to fight that. Just going to run it. Right? So play the reversal off the edge. That would be getting a short against that 69.70 level. That's the plan, right? Because that's my plan. And if that short doesn't work, I'll take the small loss, get my hand slapped, and then we'll run the long and go for 7,000. But I still like 68.50 down here. R1, S2. Straight out of the books. All right, so we've built this distribution this week, and it's not really much of a D shape at this point. It's more like just a square. It's a little lower, you know, in this part here, but it's just one big block. And it kind of highlights how this entire area is just, it's just getting traded. So we don't normally do it, but let's add a little perspective here. This was Friday's close right there. And you can see what we've done this week. So, looking at all of that activity, at first blush, you'd think, well, it's a big gap up and there's a lot of volume. It's probably liquidation volume. They're probably liquidating, right? Like GTFO. Not looking at the open interest, it shows that they are adding to positions, not liquidating positions, right? We are looking at open interest. And they have not been very strict about it. They've been adding to their positions everywhere in this zone, which is why we have one big block rather than highlighted areas, right? Like they weren't just piling in only at the top or only at the bottom. They've been piling in through this entire range. Cool, cool. You guys see how I did that, right? So you can go back and do that on your own. You just add open interest futures, turn the volume on, show open interest. Yeah, yeah. Ten-day, 30-minute volume profile in TPO. I think the TPO really demonstrates what we've been talking about. It's not one big central um, high volume node, but instead it's just collectively across this entire range from 6950 all the way down to 6900. They've been buying willy-nilly, just hand over fist, and they don't really seem to care about a very specific highlighted level. 82 is filled up nice. That is an old cog line. We don't use it anymore, but it still gets my attention from time to time. 92 is the cog, but 82 and 42 still got a lot of love for those levels. We don't have any expectation that the central pivot here, this point of control, we don't have any expectation of it moving until at least Friday. Now, if we build out a lot more volume around that 6940 area, that is possible. But one, we'd have to get back up there. And then two, we'd have to put in the work, enough work to eclipse all of this. Because the candles that made this aren't going to get hit until at least Monday of next week. So we won't start to decrease that liquidity off of this pivot point, this point of control, for days yet. And that means it's not going to move unless we can build out a new level somewhere that eclipses it. So it's a race on the clock. Can we put enough volume in here before Monday that we bring it up by default? Or are we just going to have to wait to wipe these candles out and then have it move up on its own? All right, we hit that VPOC from the 24th. We hit that yesterday. We're done with it now. We don't need it anymore. We don't have a new VPOC from yesterday because we hit that overnight and then we crushed it and we broke back through it. It is worth noting price responded to that level multiple times in the overnight. We had it here and then these two levels. So yeah, when markets opened, they were violent and was able to break through it, but they weren't able to keep it and dropped back down through it. Without that opening sequence or that open violence to really add to the push on its own, price wasn't able to get through there. But we're done with it. At least I'm done with it because I only carry them forward if they haven't been hit. Honestly, though, the textbooks will tell you to carry it forward anyways. I've got enough pivots. I don't need more, but you do you. Right? It's not a bad thing to carry these forward. I got enough lines and levels. I wiped up one of my charts. Yeah. We are still more than 3.5% above the 10-week. It's a little extended. Above this level, we don't normally hang out. It's a little too much. So we expect to pause or to fade back the other direction. But it's not extended to the point where we're expecting some sort of violent mean reversion in the other direction. That's the weekly. On the daily, we're at 1%, just a little past 1%. It's not a big deal. We're not overbought to the point of expecting some sort of mean reversion. The old question of did we move too far too fast and does it owe us a pullback? The answer is no, it does not owe us a pullback. We did not move too far too fast, and we have no expectation of a mean reversion simply because of how far we've gone. And that's really all we need to know out of that. It's at a healthy level, it's not extreme. And looking at the range for the week, this is what we're supposed to stay within by Friday's close. And so far, it's looking like we might do that. You can see those three tests we were talking about, how 3 different times we tried to get through that 69.32 cog line and we just have not been able to keep it. But it also lines up with that weekly level. So we'll see how it goes at the end of the week. If we can stay up here at this kind of elevated level, one thing to keep in mind is how often the SPX closes on one of these lines. Now, don't get me wrong, when I ran this strategy, I ran it for an entire year. And they were all very short duration butterflies, which have a low win rate to begin with. I think the stats for a 1 to 2 day butterfly, not 0-day flies, right? Just 1 to 2 day butterflies, the stats are like 8 to 10% win rate. And you might be thinking, well, who the hell would want to trade it if it only wins 10% of the time? Well, even those 10% of the wins far, far outweigh the 90% of the losses that you take. But it's a significantly difficult thing to do to run a strategy that loses 90% of the time, right? Even if the losses are really small, it's demoralizing and it just sucks, right? To lose 90% of the time, even though the strategy makes money. But when I was running it on these levels, which is what I was playing against, the weekly expected move, I had the loss rate down to 75%-ish, right? A couple of points here or there, either direction. That's more than 100% increase in the win rate. And again, the losses are very small. We're talking, 5 pennies, because, that's as small as you can get the trades. Very small. They weren't all 5 pennies, but you can get them pretty small. And yet the wins, since the bare minimum is $5 wide, you're looking at, $3.50, $4 for risking 5. The strategy is a significantly powerful strategy, but it just sucks to lose over and over and over and over and over and over again. Weekly expected move levels. And it's a better strategy now than it was when I was running it, because now you can run it every single day of the week. Back when I was running it, it had Monday, Wednesday, and Friday expirations. I exceeded Thinkorswim's server allocation. If you get those errors that say you're looking at too many columns, build yourself a watch list that is empty, and then just set all your watch lists to empty except for the one that you want to see. It'll help. So looking at what's down this morning, China, Bitcoin, bonds, Mag 7, China again, tech. Chips are down a little bit, not enough to really meet our qualifications. Same thing with financials. If you're looking for a rally day, you want tech and finance and consumer discretionary, and we don't have those. And you want things like China and Bitcoin. We don't have that either. So at the moment, we don't have even the possibility of a rally day right now. But this is a good way to start to see a rally day come in, right? Because we're down some. It's not, massively down. XLF, not even 1/4%. Chips, not even 1/4. So, having a little bit of a pullback to then expand even higher, it's a nice setup, but we're not bullish yet into the open. Looking at what is up this morning, we got gold miners, uranium, nat gas, and Mag 7 down volume is up. Of course, it was down more than 14% in a 5-day period. So a little move to the upside is kind of warranted after such a drastic move down in 5 days. It doesn't look to be much of a capital rotation. We're not seeing a bunch of staples and industrials and that sort of thing. KWeb is starting to look more and more like that old Carvana chart, right? Where it had the beat down and then the big base and the possibility for a new leg back up. Getting there a little bit at a time. Down this morning, big gap, hanging out down here below 40.5. That's very likely the line in the sand if you want to see it get back up again. On the week, though, we're still holding that breakout from last week. Barely. Let's put that on a daily. Maybe we're not holding it. Resting on it, maybe. All right, it shows Bitcoin's down quite a bit, but looking at it, it still seems we're like on the edge of yesterday's low. See if we can find some structure, maybe a 111 or a 1236 reversal here. The main thing is it hasn't completely just fell the hell out of bed. And if it does, then getting back down along that 17 level for, like a longer term concept here. Turn the corner, get back along those lows, see if we set a lower low or not, and then look for that MACD cross to hold and make a run back towards the 0 line. Not that it did a lot of good back here, right? We crossed, looked really good. Didn't help. and then we weren't able to get through the 0 line. Lower highs and lower lows in a continuous swinging pattern, lower and lower and lower. With a bigger level at 16. That might end up being our reset point. All right, Mag 7 is inside day, but it's holding up well. Get back through the mid and then yesterday's open to challenge the high that was set, 69.5, basically. All right, all things considered, we got a pretty good day lined up, right? Let's just wrap this up here. As it always is, it's GTFO, right? You got to get out of the box if you're going to do anything else. Otherwise, you're just playing in the slop and the chop. So this is the Globex range. You could snap a 111 and a 1236 onto this. I'm not really liking it all that much because it just lines you up for the low of yesterday, but whatever. If we get into the 111 and we can't get through it, then there's your reversal. Get us back inside the range again, challenge the mid, run for the top. Otherwise, get out of that box with the goal of getting down into yesterday's range, low. And if that breaks, then we go for the low from Monday. And if that breaks, we go for the Friday's close. Level by level by level. And it all starts with getting the heck out of our own Globex range. It's a nice setup for the day. We've been compressed for days. The market's going to want to look for an expansion. Let's do the thing, right? What else is holding us back? There's not much on the economic front until we get into next week with QRA. And so many people don't even know that QRA is coming. Smart money ain't all that smart. Depends on who's running the fund. What I got for you guys, be careful, be safe. Have a good day. I'll see y'all tomorrow. Let's make some money.